Okay, so with that, I'd like to hand it over to Mickey for the opening comments.
Now, I have two segments. I have a 45-minute segment to introduce everything, or 1 minute. I'll do it 1 minute or less. So welcome, everybody. It's a pleasure. We're probably all zoomed out, but I think a combination of information and entertainment tonight will be very helpful. And Michelle Boyce is the newest member of our team. She comes with 20 years of experience in the industry. So welcome, Michelle. And also from our team is Joanna Quinteros and Stuart Appel. Some of you speak to them time to time. And Michelle, back to you.
Thank you. So yes, as Mickey said, I'm the newest member of RFS. So I look forward to getting to know all of you on the screen more. So when we were developing the questions for tonight, we really centered around one topic that's always seems to be in everyone's conversation. And no, it's not COVID, okay? So you dodged a bullet there. It's taxes, okay? So in all the questions tonight, it's gonna be centered around taxes. We're gonna talk about some tax reduction strategies, some tax diversification strategies, and then also some estate tax mitigation strategies. And the reason that we chose taxes in those three topics is because no matter where you are in your financial journey, you know, or your children are in their financial journey, maybe they're getting started out, maybe you're getting ready for retirement, or maybe you're to that point in your life where you're thinking about your legacy, that one of the topics that we're covering tonight, we're sure it will have some sort of impact. So with that said, let's jump right into the panelist discussion. So the first question I'm going to throw out here for you, Jerry. So oftentimes we have clients that have low cost basis assets. Okay, maybe it's a family business, maybe it is a rental property that's really appreciated in value, or even a singular stock position. Okay, but most people are concerned about selling those because of the capital gains tax they endure. Could you maybe share some strategies that if someone finds themselves in that position that they could consider?
Sure thing, Michelle. As you know, that is one of the hottest topics in financial planning today. It was super hot leading up to the end of the year last year, and that was largely because the original version of the Build Back Better Act was contemplating significantly increasing capital gains taxes. So a lot of folks were in a position where, oh my God, I better hurry up and sell this, whether it was a stock, whether it was a company, a piece of real estate, any asset with a low cost basis. Here we are now in end of January, and Build Back Better has stripped out any and all semblance of tax increases for individuals. And most of the corporate tax proposals are also stripped from the proposal. So we don't know where it's going to go in the future. Maybe our mentalist could predict the future too. I don't know, but we certainly do not know what the future will bring. However, that said, with these high deficit kind of spiraling out of control and the anticipation of higher interest rates, income taxes, you could probably assume that will be higher rather than lower in the immediate and midterm future. So with that said, to answer your question, Michelle, it's not unreasonable to start with a baseline. Let's look at what it would look like for me to sell this asset. So we look at what's your cost basis, what is the selling price, we subtract those two numbers, and we come up with, here's what your taxable capital gains amount would be. If you hold the asset for a year or more, that capital gains tax would be taxed at long-term rates. The highest rate for long-term capital gains right now is 23.8%. There's a 0, a 15, and a 20% federal rate, and those could be supplemented by the 3.8% surtax. So the bottom line, the top rate now for capital gains long-term is 23.8. And guess what? That's not a horrible number. Historically, Mickey and me with the gray hair, we can tell you, we remember when capital gains taxes were 30% or more. So 23.8 is not a horrible starting point or a benchmark. Then we go into the different strategies that are worthy of contemplating. They come in three categories. One is charitable. The other one is what I call mainstream and kind of safe. And then there's the more exotic strategies that may have some planning risk where the IRS might challenge the strategies. I'm going to mention them, but we're not going to drill down. We don't really have, we can do a whole meeting on this topic, but the charitable strategies are the Charitable Remainder Trust and the Donor Advised Fund. So we are going to spend a little bit of time on that. The more mainstream strategies for capital gains mitigation would be for C Corps, if you're selling your business, qualified small business stock. For other folks with low basis assets, there's something called opportunity zones, where you could actually sell your asset and end up buying something in one of these areas known as opportunity zones and defer the tax. And then the more exotic strategies are referred to as the Deferred Sales Trust. That could be challenged potentially. The Delaware Statutory Trust. And there's something called Partnership Basis Swap. Bottom line, I work with Mickey and Michelle and the company, and we know all the tricks. We know all of the different types of strategies. You may hear on the golf course, you might hear at the gym. We've seen it all. And some of these strategies work and others have planning risk associated with it. But once the client's well educated on the pros and cons. Yeah, go ahead.
Yeah, so a key point you're making, Jerry, is there's a host of alternatives to think about. And what's important is not to just take the first one you hear about, but to explore the issue carefully to make an informed decision, I would think. I'm done.
Yeah, and that's kind of what I was going to end with, Mickey. I definitely share your position on that. It's all about understanding your objectives, what the pros and cons are for each strategy, and we'll help you make an informed decision. Michelle, back to you.
Thank you, Jerry and Mickey. Yes, everything is very customizable to your particular situation. So, Jerry, in that last answer, you mentioned some charitable options. You know, charitable options may be a charitable remainder trust or a donor advised fund. Oftentimes when we're meeting with clients, we find that they really want to fulfill the charitable intent and be philanthropic, but they're worried about what impact that's going to have on their income and ultimately their legacy. They see it as a seesaw. You know, if you give money to charity, well, then that's less money for myself and my heirs. Can you talk a little bit about some of the strategies where people can be charitable, but still end up having more income from themselves and more money for their heirs?
Well, that sounds a little too good to be true. And you know what Mama said about too good to be true strategies, right?
Right.
But that said, there actually is a strategy, and it's called the Charitable Remainder Trust, where you really can do some good things, not just for the charity, but while at the same time, you could do some good things for yourself in the form of income stream and for your family in terms of what we leave to your heirs. So first, let me tackle the easier of the two strategies. The donor advised fund, think about it this way. If you're going to have a very large tax year this year, for whatever reason, you're selling a high gain position asset, you're selling your company, you're just having a really strong income year, and you think that this is a good year to get a deduction. Here's the question I ask. It goes like this. What do you feel you're going to give away to different charities this year? How about next year? Do you have a pattern? Could you tell me what you think in the next 5 years or 8 years? What is the amount that you're going to be donating to charity? Now, not everyone can answer that question, right? But the extent to which you could ballpark it, there's no reason why you can't front load all of those deductions this year. And what I mean by that is you could make a big gift this year. Let's say you're giving away $20,000 a year the next 8 years. You could take $160,000, right? That's 8 years worth of gifts. And you could make a gift today to a donor advised fund of $160,000. Now, get a $160,000 deduction this year, but you don't have to give the charities the money all at once. They stay in a donor advised fund. Mickey's firm invests that money for you. It grows. And then each year you decide, how much do I want to actually give to a physical charity that's on that donor advised fund list? So that's the easy one. It really doesn't cost your heirs anything because this is money that you're going to be gifting anyway. So that's the donor advised. The only other thing I would add to that, not to get too in the weeds, but you're limited to 30% of adjusted gross income. And you could make a gift to a donor advised fund of $160,000. Now, not everyone can answer that question. each year. That's the maximum amount you could deduct. So every 100,000 of income, you can get a $30,000 donor advised fund deduction. If you don't qualify for the full deduction, you get to carry forward the unused amount for 5 years. Now we get into the charitable remainder trust, and I think Michelle created a slide for this one.
I did. Let me share that quick. We find it's easier to follow along when we're talking numbers.
And here we're starting out with an asset that has a very low cost basis. This is an asset that maybe was purchased many years ago, and it's currently valued at $1 million. But way back when, you paid maybe a couple of $100,000 and you've depreciated it, where the cost basis is now $100,000. So there's $900,000 of gain embedded. Now, if you had to pay a tax on that $900,000 of gain, it would be about $200,000, give or take. That would leave you, after you pay the $200,000, that would leave you with $800,000. And if you were to invest that $800,000 at a hypothetical 5%, you'd end up with $40,000 a year in income that's taxable. After tax, again, hypothetical, $28,500 a year. I'm sorry, $28,000 a year of net after-tax income from the net proceeds of the sale. Okay, pretty simple math, and this is an oversimplification. But what if we took that $1 million asset with the 100,000 basis and gifted it to a charitable remainder trust? Well, the first thing you need to know is, what does that mean? A charitable remainder trust, but that's a vehicle that can pay you income for life, and then when you die, what's left goes to charity. Well, how much income? It depends on how old you are, because we look at your life expectancy, but we can maximize your the amount of income coming back to you, and what would end up leaving to the charity would be about a minimum of 10%. If the charity is going to get less than 10%, it fails the IRS rule. So in essence, you move the $1 million, now you sell the asset, and it nets you the full $1 million. There is no capital gains tax. Now, you might have some closing costs, but at the end of the day, you got something close to $1 million to invest now. And again, if you invest that at 5%, that gives you a $50,000 income, assuming 5% of $1 million, because remember, you paid no tax, and that'll net you $35,000 a year in income. So there's a savings in income. There's actually an arbitrage. So the difference between 35 and 28, there's 7,000 more income coming to you. If you took some of that 7,000 and bought a life insurance policy for your heirs, well, then that's your have your cake and eat it answer, right, Michelle? It may sound too good to be true, but you're getting a higher income stream. The charity is getting a good amount of money at the end of at your death, but your kids are not disinherited. The life insurance is what we call a makeup provision.
So
Does
Jerry,
that make sense?
yeah, Jerry, just a quick question, Mickey. So what's the disadvantage of a CRT?
Well, the disadvantage of the CRT, so you still control the asset. You could be the trustee, but you cannot take all of that money, the principal, and buy a boat with it. You can't use it for personal things. You could take the income that it pays you and buy what you want with it, and you control how it's invested, but that principal is no longer available for you to spend on personal use items. You cannot run a business from within that trust. You can't buy real estate and live in it. So you're giving up some level of control over the portfolio, but you can invest it with whatever risk profile that you feel you're comfortable with.
Yeah, and just to add to that, that's where you're getting it out of your estate. So if you have an estate tax problem in the future, an estate tax issue, this is a way to get some money out of the estate, but still utilize the income off of it. So thank you.
That's a great point, Michelle. And the insurance would be also purchased and held out of your estate.
Absolutely. All about reducing the taxes, which is closing that first section on tax reduction. Okay, so a couple different strategies there talking about how to reduce taxes today. some different tactics. So now we're going to talk a little bit different, still on taxes, but more about diversification. Okay, so in the Build Back Better Act in its current form, really not much changed in the tune of taxes. The bracket stayed the same, the surcharge stayed the same, and to much of everyone in our industry's surprise, the lifetime exemption stayed the same. Okay, so Jerry and Mickey, if you're borrowing John's crystal ball here, what does it tell you about the future of where taxes are going and what type of planning people should be considering?
I'll turn it over. Go, Jerry. Go, Jerry.
Well, but Mickey, I'm going first because I have the crystal ball right here. I don't know, John, if that makes you jealous or anything, or if you got one of these. But no, I of course, tongue in cheek. The reality is, Michelle, as we said earlier, with the deficit spiraling out of control, interest rates going up, so the debt service on that deficit is going to be quite high. There's going to be a need to find money somewhere. So the smart money, and what I'm hearing from economists is that income taxes in the short and medium time, we can anticipate some increases. We don't know where they're going to be, whether it's going to focus on corporations or individuals. But you know, we do have an indication of where it's going to be in the future. As such, loading up on contributions to 401k all the way up to the max may not make as much sense, but things like Roth IRA and other tax-free forms of income are going to be much more attractive in the future. So we call this management of your various sources of income. How much is income taxable as you go? How much of it is tax deferred? And how much of it is tax-free?
Mickey, you have anything to add?
Well, I was going to say something about Roth IRA, but I think you're going to cover that, aren't you?
I am, yes.
So I won't say anything. I'll watch.
Okay, so a word in there that Jerry mentioned was diversification. Okay, and that's a hot topic word, and it's usually associated with your brokerage account or your investment portfolio. You know, that's been preached for ages. You need to have diversification across the different sectors. But what's not talked about as much is tax diversification, which actually in the long run is even more important. You know, so there's 3 ways that your money can be taxed. What Jerry mentioned, you know, 401ks, that's deferred. So you pay no taxes on those dollars now, the earnings are deferred, and when you access those funds, it's 100% taxable. So that's the first way. The second way is taxable, or what we like to say, taxed along the way. These are your brokerage accounts, your investment portfolios. You know, so you're paying taxes every year. You're going to get a 1099, usually to the capital gains rate. And then the third area is tax-free, where you pay the tax today, and then all of the growth and the future earnings on that, you can access tax-free. Now, out of those 3, one of them has a word in there that we all like, and it's free. You know, everyone likes something for free. So there's actually very limited options of where you can build your wealth tax-free. Jared, you want to cover one of those ways?
Yeah, and but just in summary, you know, it's tax-free. It's tax-free. There's only 3 ways to get tax-free income: municipal bonds, Roth, that Michelle's going to talk about, and then something that you don't expect to hear, but cash value life insurance is one of those 3. Congress has created a law that allows cash to build in a policy and then come out tax-free. Mickey's going to speak to that. I'll start with the municipal bonds. Municipal bonds, there's nothing wrong with municipal bonds. They are an integral part of a diversified portfolio. How much goes into your portfolio depends on your facts and circumstances. There are people a lot smarter than me about portfolio design. But municipal bonds, they have their place, and you shouldn't have any more or any less than your asset allocation model dictates. But that's just one method of creating tax-free income. Michelle, go to the next bullet. Is Roth.
So a Roth IRA. Okay, so a Roth IRA is a great way to build future tax-free income. But it's so good, when things are good, they have limitations. So the government puts limitations on it. So it's 2 limitations with the Roth. The first is how much you can contribute. You know, either 6,000 or 7,000, depending on your age. And then they also limit what your income is. If you're over a certain income, you can't contribute to a Roth. But just because you can't contribute to a Roth to start building tax-free wealth doesn't mean that you can't convert to a Roth. Okay, so I'm going to share my screen again because we're going to talk numbers real quick to give you an example here. Okay, so this is the 2022 tax brackets. Okay, on the left-hand side is the single, the right-hand side is married filing jointly. Okay, so we're going to look at the 24% bracket here. It's a very wide bracket, 178 of income to 340. Okay, so I said in that last little tip there that if your income is over 214,000, you can't contribute to a Roth IRA. So someone in this bracket under 214 can. But let's say we have a couple whose AGI is 300,000. Okay, so they can't contribute to a Roth IRA, but they have what we call 400,000 of wiggle room here. Okay, that's a technical term, by the way. Okay, so they have 40,000 before you're going to jump up to the 32% bracket. So why not convert 40,000 of your traditional IRA over to a Roth and then let those tax-free earnings start to compound? Okay, if you heard Mickey and you agree with what Mickey and Jerry were saying earlier of where you think taxes are going in the future, it'd probably be a good idea to lock in that 24%, because then that portion of money doesn't matter what happens in the future with taxes, it's tax-free. Okay, so that's one way.
Now, Michelle, on the Roth, the money's going to sit there for a certain period of time to enjoy the tax benefit, correct?
Yes, 5 years.
Right. And so essentially, you put it in, if it sits for 5, it's tax-free. If you take it early, it's not tax-free.
Right.
And if you believe taxes are going up in the future, then you want to try and get as much tax-free income coming out later that you can.
So, and then another thought here is this would work more for a younger generation. So maybe your children on the call, okay? So the tax bill on that conversion would be $9,600. So maybe someone doesn't have that extra $9,600 to be able to pay the taxes to make that conversion, okay? But as the parents or generation one, what if you considered gifting them that $9,600 to pay that tax bill? So now you've gifted them well below what you can gift, and now they can create that asset that's going to grow and accumulate tax-free for their future. Okay, so if you're gifting your children money on an annual basis to have a real impact, rather than just spending it or saving it, what if they used it to pay the taxes to convert to a Roth IRA? So Mickey, the last topic there of the permanent life insurance, you want to speak a little bit on that?
Yeah, I'm just going to speak just a minute on that. I mean, with current tax legislation and a life insurance policy, the earnings grow tax deferred, and you have the ability to withdraw and borrow without paying tax on gain. And at death, it's a full tax-free exchange, the beneficiaries. So that's a place for some people to build a cash accumulation account to take out later for income purposes on a relatively tax-free basis. As long as the policy matures some days of death benefit, there's never taxation. Now, we're supposed to be done at 6:25 to prepare for the second half. So, of course, the one person that's cut out speaking is yours truly, but Michelle, I'll come back to you.
Well, thank you. So we've got one more question, then we're going to wrap up quick, and then we're going to hand it over to John. So the last question was in regards to estate taxes. Okay, so the Build Back Better Act actually did not include any changes to the current exemption of 12 million. Okay, but under current law, we do know that that's going to sunset back to 7 million in 2026. So if you guys just want to give a few points that people should be thinking about of what are some strategies that they could be thinking about between now and 2026 when we know that it's going to be reduced.
So I'll jump for a minute, then I'll turn it over to Jerry. So there's a lot of debate in Washington about eliminating the estate tax, raising the exemption dramatically. So tell me who's in power and tell me the day you're going to die, and I'll tell you exactly what the estate tax will be. But I think with, as Jerry said, with this massive deficit and interest on deficit, that there's enormous pressure to raise and collect taxes for government. So, which is probably why there's such pressure on the estate tax issue. If you eliminate it, there's a massive savings to the population and a loss of revenue to the government. So I think one thing is clear in estate taxes, it's like regular taxes. It's ever changing. The only person in America that I'm aware of that outsmarted the government was George Steinbrenner. He died in 2000. That was in 1 year that they had no estate tax. He transferred the Yankees estate tax free. Now, some would say he was already dead, but they kept him alive in 1999 so that he could enjoy the estate tax free transfer in 2000. So, Jerry, I'm back to you.
Yeah, I'm going to be real short because I know we're out of time. But the strategy that is most often contemplated in this environment that we're in looks at the following. The estate tax-free amount right now is $12 million, okay, per spouse. So that's $24 million per family. The scheduled tax-free amount is going to come from $12 million. It's going to come down to about $7 million in 2026. That's the Trump law. 2026 to 12 comes down to about 7. That difference of $5 million, right? The estate tax on that would be $2 million. So what does this mean? If someone gives away $12 million today and locks in that $12 million amount, their family is $2 million richer after you die. Do that for both spouses, your family's $4 million richer. Why wouldn't you do that? Well, you're giving it away. It's not yours. I'm going to end on this note. There is a strategy. It's called the Spousal Lifetime Access Trust, where you can actually give it away and your spouse could be an income beneficiary. More on that would be beyond the scope, and we're out of time. If any of these topics that we've discussed today are of a heightened interest, we can come back another day and drill down further. But Michelle, that's, I think, the hottest topic under discussion today is the Spousal Access Trust.
Absolutely. So thank you, Mickey. Thank you, Jerry. So I think, audience, kind of what you took from this, we covered a lot of different topics. If you want to learn more about any of them, obviously we're here to have one-on-one conversations to see how it fits your particular circumstance. So enough on taxes, right? It's kind of like COVID. We can only talk about COVID and taxes for long enough. So now I'm going to turn it over to Jon Finch, the mentalist, so that we can be entertained and know he cannot make taxes or your wife disappear. Okay, we've already asked him. So Jon, take it away.
Thank you, Michelle. Yeah, I'm Jon Finch, and if you look in the upper right corner of your screen, will someone make me co-host or host?
Yes,
Or,
I will make you co-host.
thanks.
There you go.
If you look, thanks. If you look in the upper right corner of your screen and click View, you'll see it says Speaker View and Gallery View. Make sure it's set to Speaker View, not Gallery View, for the best experience. And while you're there, set it to full screen, and you'll see a clear picture that way. Now, who here? Oh, we'll start with Jeffrey. Jeffrey. Nice to meet you, Jeffrey.
Oh, Jeffrey, you're muted. Can you unmute yourself? There
All
we
right.
Ah, there he is. Jeffrey, I'm gonna name some, you just listen closely and I'll name some things. cities, countries, I was going to say mountains, but never mind that. Things that are blue, heavy objects, celebrities, famous wars. What do these things have in common? These are categories. It's not important that he knows the answer. It's all right, Jeffrey. You just name a category. That, by the way, Jeffrey, if it helps, no one's ever answered that correctly.
No
But
pressure.
yeah, it's called categories. So, Jeffrey, you just name a category. Well, first, Jeffrey, you just say nuzzy guzzy, fresh and fluzzy.
Fuzzy, fresh, and fluzzy.
Guzzy guzzy.
Now all your problems just went away, Jeffrey. Now, Jeffrey, you name a category.
Music.
That is correct. And now, Jeffrey, we need someone else. So we've got music. And we'll use Richard. Did you just join?
I'm here.
Thank you for volunteering, Richard. All you got to do is say Ricky Ticky Bobby Wobbin. First, that's the first step.
Say it again, please.
Ricky Ticky Bobby Wobbin.
Ricky Ticky Mommy Whoppy.
Bobby Wobbin. And Richard, all you got to do is take this seriously and believe what you're saying. Only then will this work.
I believe.
Good. Ricky Ticky Bobby Wobbin. And then something to do with music will pop into your head.
Okay.
Go ahead, Richard. Did something come into your head?
Got it.
Good. In a loud, clear voice, what music popped into your head?
Neil Young.
Neil Young. And nobody could have predicted that Richard here, you haven't met me before, right?
No.
You swear to everyone. You tell them that we haven't met, Richard.
Have not met.
You see,
Oh, wow.
you got it, Richard. It was Neil Young.
Hmm.
Impressive.
Well done, Richard.
Nice.
All right, Richard. Now, I'm through with Richard. What we need for this next one is someone with an equally fantastic mind. And someone who everyone here trusts. So, Leonard.
Uh-oh.
How you doing, John?
Amazing. Thank you for asking, Leonard. We're going to test your mind power. Can you tell me what this is?
It's a square.
Right. You've done this before?
No.
All right. What's this?
It's a card.
Yes, that is correct. It's a circle on the other side. There are
Oh.
5 different symbols, Leonard. And we're gonna test your mind power. Just like we tested Richard's with Neil Young, but slightly, this will be, maybe you'll find it easier. 5 shapes. And there's an envelope here. Might be important later. If there were a 6th shape or design here, you know what? I'll help you. Leonard, on the screen before you, you see all these shapes and designs. Which do you feel drawn to? Leonard, don't let me influence you.
Should I pick one?
You should. Everyone wants you to.
In my mind, I pick it, or do I click on something?
You use your words. Leonard.
Use words, huh?
Yeah, as quick as you can, Richard. You've got 5 seconds remaining. What symbol, Richard? Leonard.
Leonard,
Never
that's
mind,
okay.
Richard.
The
Okay.
trick question.
You want me to say it?
Go ahead, Leonard.
Bow and arrow.
All right. That was good. Excellent. Oh, I'm going to mix these up. Same 5 symbols. Where does this go? Leonard.
With the question mark.
No.
Okay.
I'll tell you, I'll give you a hint. It's one of these 5
All right.
shapes.
Let's do the square.
You want to find out now how you did, or wait?
What's that?
I'm going to show you how you did. See?
Yeah,
You did it.
I
Look
did
at
it.
this. I mean,
That's amazing.
let's use, I'm going to mix these up. What's this one?
Circle.
And this one?
Squigglies.
Don't guess.
Squigglies.
Okay.
That's what I'm seeing.
That's good. He listened to his heart. I tried to pressurize him, but instead he listened to his heart instead of letting himself be.
Plus sign.
This goes with the plus sign?
Mm-hmm.
And this?
That goes to the square again. And of course, that's by process of elimination, that gets a star.
Well, don't complain. You basically mopped yourself into this corner. You want to change your mind on that one?
No,
It was the star, right? That was the last one?
yeah.
And you want to stick with it.
I'd like to. Jeez, that's amazing. How do you do that?
This is good.
Yeah.
Leonard, I want you to see this. What do you want to see next, Leonard?
I want to see the circle.
Circle.
Wow. The squiggly. I remember they had a thing on Columbo one time, I think it was, or Monk. It was
And
Monk.
a cross and a square.
Yeah, you got them all. But they did it by writing. And they
You
could
got
tell
them all, Leonard. What do you mean?
Leonard,
I
you
got
should play
it.
the lottery. You should play the lotto. Like you're predicting things.
That's pretty amazing.
Say, Leonard, speaking of Columbo, one more thing before you go. There is just one thing. We haven't gotten to the envelope. It's been here the whole time, Leonard.
Yeah.
Want to see what's inside?
Uh-huh.
when you listen to your heart, Leonard, what do you feel is inside the envelope?
I'm gonna guess, and I guess I feel it's a square again.
It's none of these boring simple
Ah.
shapes.
So what could that be? Interesting.
Does anyone
Uh,
remember what his first impulse was, Leonard's
Bow and arrow.
first
Bow
impulse?
and arrow.
Yeah, with the bow and arrow. Oh my God. That's amazing.
It was the bow and arrow.
Yeah,
You got it.
this guy's a mentalist.
Wow.
Leonard got it. Let's hear it for Leonard.
Lenny.
You hear that, Leonard? They're rooting for you.
I heard
Or
it.
one of them. You heard one person clapping. Maybe two.
Maybe.
No, well, did you hear that? He still lacks confidence in himself. So please unmute yourself and give him a round of applause. That's for Leonard.
Thank you.
You're welcome. Thank you, Leonard.
My pleasure.
Thank you for your thoughts. How does am I correct in assuming everyone here has a calculator?
Probably everyone has their phone.
Yeah.
That'll work. If your phone has a calculator, go to the calculator on your phone and get that ready. Your calculator, and we need one person with a book. So that's gonna. Oh, we've already used him. So, what? Okay, great. We have a volunteer. Michael has the book. Michael, with your book. Oh, this book has page numbers. It just needs page numbers and words, plenty of words on the pages.
You talking to me? I don't
I'm
have a
talking
book.
to you.
I love
Oh, I
Zoom
thought-
too, because I'm
thought
not
you
wearing,
just
I'm
ran out and
not
got
wearing-
grabbed. Clinton, did you just hold up your hand with a book in it?
Can you hear me?
Yes, we can hear you.
Okay. Well, calculator. I could get a book though.
Oh, all right. That's okay. We'll just use
I'll get a book. There we go.
Kristen.
Okay.
2022 and nobody has books anymore.
Yeah. There we go. I got a book.
and I have an envelope. Michael, great. Thanks for doing that. He's got a book.
Big
I've got
book.
an envelope with Obama's.
It's a political book.
I'm sure it'll be fine.
Okay. What do you want me to do with the book?
Well, you just start flipping through the book, and we need one more person, and that's going to be. Oh, Mickey,
Oh, yeah.
Richard, or Michael. When you hear,
Mickey.
you hear.
Oh, Michael too.
All right.
Yeah, Mickey and Michael. Michael, when you hear the word frolicked, that's when you stop flipping through the book. that is when. Frolicked.
Okay.
You listen for frolicked, and then, Michael, you stop flipping. If you reach the end before you hear the word frolicked, then you just start again at the beginning of the book.
Me too?
No,
Okay.
you're the frolicked guy.
Okay, no problem.
I'm flipping.
Good. And Mickey, you can begin now.
Am I reading?
Oh,
I'm
It's
still
necessary
flipping.
that
I haven't
you-
heard the word frolic
it's a
yet.
song. That's okay, Michael. Thank you for your patience.
Yes, Vicky, sing the
Should I
song.
stop flipping?
Really?
Mickey,
Well,
it's imperative that you sing this song.
I sing it. I don't have a good voice, but I'm going to try. I'm going to read the words. Puff the magic rabbit lived by the sea and frolicked in the autumn mist
What?
in a land called, scroll up, please,
Honolulu.
Honolulu.
Ali.
How do you not know that song, Mickey?
And John, as a sidebar, I beat Michael in a golf match, 18th hole Saturday for $120, but I'm really happy.
He made a
You won?
40-foot
You beat him?
birdie putt. Yeah, he did. 40-foot birdie putt. Anyway, I heard the word frolic from Mickey and I stopped on a page. Was I supposed to do that?
Exactly, Michael. What page did you stop
All
on?
right.
In a loud, clear voice, you tell everyone what page you stopped on. I know you have that voice too.
Yeah, I stopped on page 191.
Yes, that is right. And we need one more person. That'll be Stuart. Stuart.
Yes, I don't have a book.
Stuart, listen to my instructions closely and follow them to the letter.
Yes.
Only then will we have success. Only one person needs a book, Stuart. Trust me. So you don't need a book, Stuart. You just
Perfect.
need to say, you say the schnozberries taste like schnozberries.
The schnozberries taste like schnozberries.
Cattywampus, fuddy-duddy, whirly-durly, Schadenfreude.
Cattywampus, furdy-durly, schwerdefreud.
And then name a letter between A and Z, including A.
Should I say it out loud?
Well, yes.
S.
Yes, good. Great letter. It's probably my 7th favorite letter. Michael,
Yeah.
you've got to find the most interesting word that starts with S on this page.
On this page is just the picture. All right, so in the picture, they are standing. So how about standing? No, better word, scenic.
Right. Well, one of the things I'm doing is I'm trying to anticipate the specific decision someone might make before I ask them to even consider the question. Within this envelope, there's a card. Look. The card says Michael will stop on page 191. Lo and behold, he will choose the word scenic. There can be no
Oh,
doubt.
shit.
See?
Wow. That's awesome.
You did it. You got scenic.
That's amazing. That really is amazing. And I've never met you before. So everyone believes.
Hand on heart. Hand on heart.
That was amazing.
I appreciate that.
I'm very impressed.
Hey, John. Can I ask you a question? It's Mickey.
Sure.
The next time I play golf with Michael, can you make his driver disappear in the 18th hole?
Sure. course I can.
Hey, that was, how'd you, I guess it's kind of ridiculous for me to ask you how you did that. Please
Very
know
well.
that I
It's
duly
it's normal.
impressed and truly impressed. That was so cool. So cool that I will maintain my friendship with Mickey for another 6 months. Even if he beats me on the golf course. Very cool.
Thank you, Michael and Mickey and Stuart. Thank you. Am I
Freezing occasionally.
I'm wondering now about time because
Right, we're about 6 minutes till 7. Did you have one more planned?
I can do something or wrap up now with that. That's a fine ending. I mean, so if you need to,
How long do you think the last trick will take?
5 minutes.
Are these tricks? I thought this was real.
Sorry,
easier
bad
to
choice
call
of
them
words.
tricks.
The show, how the last show will take.
Let's
I'll
just do
play.
it, and everyone's got their calculators already, so maybe we'll do it in 4 minutes. Calculator. We'll use, and I'm not going to. Everyone, if you can, unmute yourself, so we won't. Joanna, will you punch into? Here's what you can, and prepare yourself. If you're not Joanna, after her, I might call on you to do the same thing. So get ready. Joanna, you punch in some numbers into your calculator and then show everyone and tell everyone with a virtual background, you may need to hold your calculator in front of your face so it doesn't.
I was actually using the on-screen.
Don't worry about your virtual because just tell us the number.
Hello. Five, six, 7.
Everyone put 5, 6, 7 and then press plus. Thank you, Joanna. Clinston, your turn. You input a number, but you turn your phone away from yourself or face down and try to just use the force. Don't be deliberate about it.
32.
32 and Clinston, if you didn't already, you put in 32. Now press Clinston. Did anybody press plus already? Okay, press
Yeah.
plus.
Yeah.
Everyone press plus. And finally, oh, Jeffrey. No, Thomas. Sorry, Jeffrey, never mind. Thomas,
Yes.
you do the same thing Clinston did, or you can look at your calculator and just put in numbers because sometimes people accidentally hit equals or multiply. You just hit numbers.
Okay.
And then show everyone what you've got. Little clip. Was it 14? 14. Everyone put in 14 and then press equals. And then press plus. And Thomas, you get ready. Thomas, you get ready to call out stop. You stop me. You just call out stop whenever you want.
Stop.
Now everyone input Thomas's stop dat number 39798. Put in 39798 and then press equals. Does anyone? Else have 40,411?
Yes.
Yes, 40,411. Jeffrey, you got it? Excellent. 40,411. It's correct. We all got 40,411. All our calculators work the same. And I knew that all you apparently random people with your apparently random numbers would inevitably arrive at 40,411. How do you know that my name is Jon Finch? Jon Finch. Closer. Finch. 40,411.
Oh my God.
40,400. You did it.
Wow.
That's so cool. Very cool.
You guys, you did it. Thanks for being a part of the mental magic. I'm Jon Finch, and thank you for your